Well, good morning. Welcome back to the Broadcast Retirement Network. I'm Jeff Snyder. This is BRN Sunday for Sunday, May 1st, 2022. We've got another great show for you this week with members of the media, academia, and financial services standing by to analyze all the news and events. So sit back, relax, enjoy this episode of BRN Sunday. Well, let's kick the show off as we always do with a look at what's happening on Capitol Hill in terms of litigation, regulation, legislation. Joining us on the line to break it down for us and a lot more, David Levine, Kevin Walsh, both are principals with Groom Law Group, an employee benefits law firm based in Washington, D.C. We also know them fondly as the Legal Eagles after the Robert Redford film. At least that's where I get it from. David, Kevin, thanks so much for joining us this morning.
Jeff, it is great to be here this morning. Thank you so much for having us. Good. We hope everybody's having a good weekend, and we're excited to talk with everyone this week.
Yeah, absolutely. Well, thanks, David. Kevin, I want to come to you first to kick things off. And this week we're going to talk about the nomination process for Lisa Gomez. She is the person President Biden has appointed to become the Employee Benefit Security Employee Benefit Security Administration head, but she's had to go through a process, I think, by the Senate. What are your thoughts and any update on the nomination process?
Yeah, so listeners, when a new administration comes in, they come in and appoint new people to sit at the top and run agencies. And at EBSA, the team that was put together was, Ali Kawar, who was designed to be the long-term Deputy Assistant Secretary, and then Lisa Gomez was nominated last July to be kind of the lead singer of the band. So she was nominated to be the Assistant Secretary for EBSA, which it says Assistant Secretary. It's Assistant Secretary to the Labor Secretary. So she actually would be the head of the Employee Benefit Security Administration. And sometimes it takes administrations a little while to get up to speed, and so there was some time before the Biden team nominated her. But they actually got that process done in July of 2021. And so since then, folks have been, looking around asking, when is she going to be confirmed? When will she actually go from being a partner at Cohen, Weiss, and Simon in New York to being, the Assistant Secretary running EBSA? And, it wasn't until October of last year that she got a committee hearing with the Senate Health Committee. And then after that, there was a party line vote in December to clear her for Senate consideration. Last year, it looked like one of the things that was holding her up was that Republicans were concerned that nominating her could advance environmental social governance proposals. Ultimately, no action was taken before the end of last year, and due to some quirks in the system, if you're nominated in one year but you're not confirmed in that year, you've got to start the process all over again the following year. And since then, back through the committee, another, near party line vote at Senate Help. Lisa Murkowski, a Republican from Alaska, did vote to advance her nomination. And once it advanced with a Republican support, the thought was that it would very quickly move and we'd see her confirmed. Now, the reason we're talking about it now is because last week, Majority Leader Schumer announced that they were filing cloture on her nomination, that they were going to vote to confirm her on April 26th. And then, this past week, what happened is, Senators Wyden, Murphy, and Vice President Harris tested positive for COVID, which has left them in a position where they have insufficient votes to get her across the finish line again. So they withdrew the cloture motion, and now the Senate appears to have focused on other business for the next few weeks, and it leaves us in a holding pattern again where, she was nominated in July of last year, and in some ways her life's on hold while she's being nominated because, she's got to be ready to come in. And we're still, wondering when the Senate will get around to acting on her nomination. So David, do you want to talk at all about implications, or do you want to highlight other aspects of this that I may have missed in my excruciatingly detailed tour of the nomination process?
It was good. Actually, it was good.
Actually, I'm going to echo what Mr. Snyder said. That was really good. I don't have much to add about sort of the process item. What is the implications is something I think I can address very briefly. Inevitably, as Kevin points out, when you have a new administration, what happens is they replace the leadership. In that interim time, though, because it takes time to get confirmed, you have folks who are acting. And what that means is career staff who are smart people and know the area very well, run the agency. And sometimes there are folks that don't have to be confirmed by the Senate who are also put in place to run things. But they're not the sort of permanent confirmed heads. Commonly, what that means is what you wait until you get a confirmed head to do maybe some policy initiatives that are very important. We will have to see that because for all of you who follow the DOL, they've been pretty active in the first year plus of the Biden administration in that side. Like, give them credit. They've done a lot. But I think what happens from here is if we actually get a permanent head in place, there's been all this talk about fiduciary rule. There's talk about other guidance. It could mean that even larger projects move forward. At the same time, I know this sounds weird to talk about, but we're a year and 3 months into the Biden presidency. But because the regulatory process takes time, people are going to start thinking, when can we get things done? Because if there is a second term for the Biden administration, they have a long runway, can do a lot. But if not, between the time for notice and comment and getting things done, time moves faster than you think. So getting a confirmed head often means let's focus on big initiatives as we go forward. What they will be, to be determined, but that's something to think about. Kevin, I'm sure you have comments there.
Yeah, I mean, I think you made some great points. And in terms of timing with administrations, if you have 2 years of an administration where you have the House, the Senate, and you're in the White House, your agency has an easier time getting things done. So right now we're kind of in the halcyon days of the Biden administration from a regulatory perspective. Regulators don't have to answer to too many people. They don't have to spend many resources that they could be spent on initiatives defending themselves. Looking at the election landscape, that could be very different come next year should Republicans take a chamber. And, some resources that the Labor Department is currently spending on rulemaking or updating its website or other things may need to be spent responding to congressional inquiries. So, the having your leadership team staffed early or getting it staffed eventually is important. But, these lost days are lost days for, the nominee to be able to advance her own agenda.
Yeah, and lost days, by the way, for not only her agenda, the agenda, but also lost days for maybe necessary regulation that we need. Right? I mean, these are things we're waiting on as an industry, people inside the industry, outside the industry, that have an impact on participants, employers that sponsor retirement plans. So every day lost is a day that we don't get answers to a lot of questions. Is there a hard, fast date, gentlemen? We've got Memorial Day coming up. We just did a show on that, by the way, in terms of Memorial Day travel. Is there a hard, fast date that things need to be resolved on this before congresspersons, senators go out on break?
So Jeff, there's no hard and fast she needs to be confirmed by X day, but if she doesn't get confirmed, later this year, I think she may think hard, and I don't have information on this, but to wait around for 2 years, at a certain point you may decide it's not worth it.
Yeah.
Yep. And if she doesn't get confirmed by the end of the year, she'll have to be renominated again, and the process is just a third time through a painful process.
Yeah, sounds like it. David?
Exactly. People have lives and careers, and unless you're fortunate enough to have unlimited resources so you don't worry about what you get paid, living in this type of stasis at a certain point leads people to withdraw at certain times. So we will have to see, Jeff.
Yeah, well, more to come. Gentlemen, thanks so much for joining us. They always make time for us. They're very busy gentlemen on both sides of the U.S. all the time. David Levine, Kevin Walsh, thanks so much for joining us, and enjoy the rest of your weekend.
Thank you so much.
Thanks, Jeff, and thanks, listeners.
Bye, guys. Take care. Be safe.
Bye.
welcome back. And joining me now to discuss real estate is Jacob Passy. He's a real estate reporter for Dow Jones Market Watch. Jacob, great to talk to you again. Thanks so much for joining us this morning.
Glad to be here.
So there's so much going on, Jacob, since we last spoke. Mortgage rates on the rise. Well, first of all, not just mortgage rates on the rise, interest rates on the rise. We have seen lots going on in the mortgage rate industry, and you're probably the best person I know of to break this all down. So what's top of mind for you this week in terms of real estate?
Yeah, it's been a pretty crazy couple weeks in terms of all the data we're seeing, and perhaps concerning depending on where you stand on things. So yeah, mortgage rates, although this week they settled a little bit, but generally speaking, it's been, the past few months, it's now the fastest rise in mortgage rates in over 40 years. I mean, it's pretty unprecedented how quickly they have risen. And they're now well above 5%, which is a level we haven't seen since, 2011 or so.
Mm-hmm.
So really high. And they leveled off a little bit this week, so there was maybe a little bit of a reprieve if you were in the market this week. But generally speaking, economists expect that, with the Fed looking certain to continue to raise rates and adjust their activity, their monetary policy, to try to address inflation, it's pretty much all but guaranteed that mortgage rates will continue to rise unless something pretty disastrous were to occur, another pandemic perhaps. But I don't think that's going to happen. So
yeah, let's hope.
So yeah,
for a lot of reasons.
And yeah, exactly. And so there's already a lot of signs that this rapid rise in mortgage rates has put a pretty significant damper on the housing market. Mortgage applications have been trending down for many weeks now, dropping to the lowest levels seen in quite some time. And that's, a pretty good indicator of people's interest in buying a home, since obviously most people use a loan to purchase a home.
Mm-hmm.
And then also this week we got the data on pending home sales, which fell for the fifth consecutive month. So the pending home sales index is put out by the National Association of Realtors, and it measures basically when the contract for a home is signed, whereas existing home sales, which most people are probably a little bit more familiar with, that measures when the deal is actually closed, when the transaction closes. But the pending sales index measures when the contract is signed, which comes earlier in the process. And it's a pretty good indicator of where home sales will go in the months ahead. So now that it's, that index, the pending home sales index, has fallen for 5 consecutive months, it's a pretty clear sign that home sales are slowing. And it remains, prices are still rising. People haven't caught a break yet. Buyers haven't caught a break yet on rising home prices. But that's an open-ended question. What's going to happen to home prices? Some economists have forecast that home sales could drop as much as 20% in the coming months, which would be pretty significant. There are some, prominent folks like Mark Kiesel at PIMCO. He in an interview with Bloomberg today, Friday, said that he is thinking about selling his home in California. The last time he sold his home was when the bubble burst in 2006. He got right ahead of it, and then he bought again in 2012. So he's basically calling another top to the housing market. He's very much in the minority in folks who think that the housing market will go through another bust cycle. Most people just expect that growth is going to just slow and things will just get to a bit more of a normal pace rather than the pretty crazy pace we've seen the past few years. But it was noteworthy to see someone prominent like that say, I think things are getting so bad that I'm thinking of selling my own home before I run out of time. So something to think about.
Yeah, I was going to ask you, just with all these rate increases, and you really addressed it. I mean, we just don't know. What does this mean to somebody? So those first-time housing buyers on the one side, housing slowing, the sales have slowed down. So that means that this gives an opportunity, I would think, for the inventory to catch up, which might bode well for buyers. And does this kind of pivot things to from the sellers to the buyers? Because it's clearly been a seller's market.
It's a tough. It's pretty hard to underscore how tough this market is for first-time buyers. I mean, I've talked with many buyers who are, in the market and dealing with situations where, they're being outbid left and right. We still see a lot of investors in the market buying homes in cash to rent out. That's, especially prominent trend in some of the more popular markets across the country. So it is very, very tough. Realtor.com, according to their analysis, they suggest that, if you bought a home today, your monthly mortgage payment, because of the combination of rising rates and rising prices, is 50% larger than if you had bought a home the same time a year ago.
Wow.
So pretty remarkable stuff. What happens is anyone's guess. In terms of it shifting to be a buyer's market, the one thing that most economists will point to as, the good news, if you're perhaps, someone looking to sell a home, or if you own a home and want to see the value stay strong, is the reason that the housing market the reason that home prices have risen so much isn't the same as it was back in 2004, 2003, 2005. The reason prices are rising is because there's just such little supply of homes for sale. And also because there's just, generally speaking, a housing shortage nationwide. That's different from, the last housing bubble, where prices rose largely because it was so easy to get a mortgage that, people were buying, second and third homes left and right. And you saw kind of crazy stuff going on then. So that's not happening this time around. Mortgage standards are pretty stringent because of new regulations. And, lenders are being pretty cautious. You're not seeing risky behavior there. So, as long as the supply situation remains the same, I mean, this is the weird thing, is even if a ton of buyers were to exit the market, there's an extent to which prices could still continue to rise because there are just so few homes for sale that whatever buyers remain in the market still have very few options to choose from, and we'll get into bidding wars that drive prices higher. So it's not a done deal that, a drop in sales will lead to falling prices and everything shifting to a buyer's market. I mean, that possibility, I would never say never. I mean, and as economists I've spoke to in the past few weeks have remarked is, back in 2005, 2006, plenty of people were saying, oh, the housing market will never have a huge crash. And then sure enough, it did. So, take these projections with a little bit of a grain of salt. And I think this is all the more reason, though, that if you're trying to buy a home, you need to, be careful. Don't get, it's easy in today's market to get in over your head and get into a bidding war where you're suddenly spending way more than you can afford to purchase a home. And that's pretty risky. So, be mindful of how much you're spending, how much you have saved up, et cetera, and be careful, because I think that's the real risk, is people, getting, the kind of, excitement of a market like this can drive people to make somewhat irrational decisions. So when the market is shifting like it is now, that's all the more reason to be careful.
I was going to just say, when you start talking about economists, I know Harry Truman had a kind of a quip where he said he always wanted a one-hand economist, because economists always say on the one hand it could be this way, on another hand it could be this way. Anyway, let's talk about real quick rents. I just read a story in the New York Post. I still check, even though I don't live in the area anymore, I still check some of the periodicals there, and rents are still going through the roof, and some people are leaving, choosing to go to greener pastures. What does this say about the rental market? Because that's all these people have to live somewhere. If they're not going to buy a home, they're either staying in an existing home or they're going to rent. So what about rental prices?
Yeah, and this underscores how tough things are for first-time buyers. Like you said, you have to live somewhere. And contrary to popular belief, most millennials are not living in mom and dad's basements. They are renting. And so, yeah, a lot of the same forces are affecting rents right now. I mean, the housing shortage is not just a shortage of homes for sale, it's just a shortage of homes to live in nationwide. Mm-hmm. We were not building homes quickly enough to keep pace with how our population has grown over the past, decade plus. And as a result, there is now a shortage of homes nationwide. And that is, very much being felt in rental markets. There was a false sense of hope, perhaps, that some renters had in some of the pricier markets during the earlier phase of COVID, because you saw rents drop as people fled to the Hamptons or the suburbs or wherever. But, I have plenty of friends who live in New York City, and they got one of those, pandemic deals, and now their landlord has turned around and said, yeah, you're going to be, if you want to renew, it's going to cost you an extra, $2,000 a month, $1,000 a month. I mean, pretty significant hikes. And that's happening left and right. And then the problem is with all these first-time buyers who may be, unable to purchase a home now because of how unaffordable it's gotten, those folks are just going to continue to rent, and it's going to create more competition in the rental market. So just because, if the housing market, let's say there was, a bit more of a bubble, so to speak, I wouldn't necessarily expect rents to drop. Even if home prices drop, rents could very well stay high. Potentially in some markets you might see, if there were to be, more foreclosures or people offloading properties to get out of homes that they no longer can afford, you might see investors scoop those up and turn them into rentals, which could, benefit the market, and an increase in supply would be welcome. But yeah, it's rents are going up nationwide in pretty much every corner of the country. And there's really no sign of that stopping anytime soon, unfortunately.
Yeah, that is very unfortunate. So I guess if you're moving to or live in an urban area, expect to continue to see rents. And, we'll have to check back in as this evolves during the spring, remainder of the spring and into the summer and fall months. Jacob Passy, always great chatting with you. Thanks so much for joining us, and enjoy the rest of your weekend. We'll talk to you soon.
Talk soon. Take care.
Welcome back, and we're going to try to make sense of this wild and crazy market. Those are my words, not his. Joining me on the line, he's the lead anchor of the TD Ameritrade Network, Mr. Oliver Rennick. Oliver, welcome back to the program. Thanks for joining us again this morning.
Wild and crazy is a very fair description.
I didn't want to put words in your mouth, but I would come and see it like a real roller coaster at Disney World or Disneyland, depending on what side of the country you're on. Oliver, I wanted to start off with probably some of the biggest news, and I think just big news, not only from a market perspective and a tech perspective, but also just social media perspective, and it just was all over the airwaves, and that is the Musk acquisition of Twitter. And what does that mean to you as someone who follows tech stocks in general?
Sure. Well, from a stock market perspective, Twitter is certainly unique, but it also generally fits into the category of a disruptive business from the last decade that is having trouble and struggling. And you can, I guess, argue that is to some degree the fault of the leadership there, the old leadership, and that perhaps Elon might have a different vision. But it is more arguably what I would say perhaps showing us the challenges of distinguishing between a compelling, entertaining product from a viable, thriving business. In Twitter's case, the need for engagement and user growth always took priority over the functioning profitability of the business. And so therefore, in this period we're in over the last 6 months, where the investing community is taking a real sharp scalpel to every tech-oriented growth business and punishing it if there are any missteps in profitability or lack of clear direction for future profitability. Twitter got wrapped up in that. And so that big price decay that Twitter stock had gone through is not unique. compared to the rest of the market, the timing of some of its weakness and the degree possibly reflecting fundamental things at Twitter. But if one had to put it in the context of a broad market view, I would say that it is possibly taking a route now that many other companies in the publicly traded market will take, and that is likely to be acquired. I think that there are many businesses, in particularly the growth tech category, that probably do not need to be publicly traded businesses. And at this point, they have tapped capital markets, used them to their advantage to get the funding they need to grow their user base or develop their products. But now that it comes time to make money and fine-tune these business models, the stock price decay in the market in these particular companies tells us that some of them maybe are going to be better off private or as part of larger competitive entities that maybe could consume them. And so I think that there's going to be so much M&A. There's going to be so much private takeout. Twitter is actually a very compelling product and business, and that's why it's probably one of the first to garner the attention of somebody like Elon to change it and make it better according to what he views it, possibly making it better. But I do think that there are many, many other businesses that you can think about that have far less compelling products or services, but yet have come to the public market via IPOs or SPACs during our speculative bubble the last 2 years. And I suspect many of them will take a similar route, but probably with a lot less grace. And so if there is a broader market implication of this move, I think that's it.
Oliver, kind of pulling back a little bit, I mean, the consumers are just getting bombarded with inflation in home prices, but also gasoline prices, food prices. I know every time I read something online, and I don't use Twitter very much, but if I see something that's written on Twitter, an article, it always says, the Federal Reserve has to act, and they have acted in terms of raising interest rates to lessen the blow of inflation. But what from your perspective, this inflation has a real dampening effect on GDP, at least quarterly. But what about the impact to the market? And can the market overcome some of these poor earnings numbers that we've seen, for example, from tech companies that you were just discussing? I can't get it out this morning. Apple, Amazon, et cetera.
I don't think the market is going to be able to get through this. I've been cautioning now for about a year that the final defeat of COVID would bring the end of our market bubble. There is a need to really describe it that way because it's the most accurate way to describe it. I think that a lot of investors have been willfully disconnecting their hopes from reality in thinking that this is either a short-lived hawkish attempt and trial period from the Fed, or that the market did not get to dot-com level valuations. But the fact of the matter is that the market did get to the most expensive in the history of recorded equity prices, with the exception of a brief moment in dot-com. But one could actually look at other valuations over the last year and say it's even more expensive, price to sales and other metrics. And a lot of that has been explained away and justified through either the lack of alternative investments and the lower yields that had been suppressed by central banks, or they've argued that this new type of revenue-heavy, cash flow-heavy tech businesses don't need to have profitability. And we're seeing that is also a little bit of a myth. So you're seeing a lot of things really come together here in a very, very bearish but realistic fashion, and one that is very sustainable in nature. Take the Fed just firstly. If you think about the two general weaknesses of the market right now, the first is the interest rate path the Fed is embarking on, and the other is the peak growth as our economy emerges from the COVID period of high-tech demand and all these companies that will never be able to reach the year-over-year growth numbers that they hit over the last couple of years. The first one from the Fed looks very sustainable because even if inflation has peaked, there is no sign that it is quickly rolling over. A lot of people like to think right now that inflation has peaked, which in itself is somewhat of a bold supposition at this point. It is very much a kind of risky timing call to think that it has peaked, but it may have. The problem, though, is not about it really peaking. It's about what level it settles back into. And it looks like there's very little hope that inflation will settle into a level that allows the Fed to resume their highly stimulative and accommodative policies from not just COVID, but the last decade. Much more likely is that even with potential decay in consumer activity or weakness in the economy, inflation will remain at such an intolerable level that the Fed is forced to continue down with a steady path of rate hikes. They may not come as swiftly and as powerfully if the economy does hit a recession, but it looks like right now there's very little to get in the way of the Fed's need to combat these prices. And even though their only way to combat these prices is to lessen demand at this point, the Fed can't build supply chain ports, they can't build factories. But the pressure to combat this inflation when it is so destructive right now in many different markets and economies and sectors that they don't really have a choice. I also think that there is an understated purpose that the Federal Reserve does not tell us directly, but we can imply from their language and see in the markets that they know that this is an extremely unstable market condition we've been in, and that extremely elevated asset prices, billions of dollars of market cap wrapped up in worthless cryptocurrencies are allowing people, and worthless stocks too, are allowing people to feel unnaturally safe without true employment. And so if they depress these prices and cause lower prices and asset prices in the market, that is probably going to lead to more robust employment to fill the 10 million jobs that are open in America. So the Fed is beginning a path here that could be years in nature and likely should be at least until we get real clear recession signs. And then the other side of the actual earnings and fundamentals, we have companies like Meta, Facebook, that changed the world 15 years ago and completely brought us a whole new way to interact, a whole new way to live our lives. And now this company's main objective is competing with people dancing on TikTok. So it's just a hugely different environment we're in, a gross really sea change in the disruptive nature of what these businesses are doing. Their core businesses and services are set. They're going to be great companies for a long time that can generate profits, Amazon, Facebook, but who knows, Amazon just missed earnings. So it really is a fairly dire picture right now. And technically all this has shown up in the market through price action that is indisputably bear market action.
We only have a few minutes left, but I wanted to ask you about meme stocks. And it seems like only yesterday we were talking about GameStop. I remember you and I having conversations about the impact of GameStop on trading. And here we are. There are other brokerage firms that have seen contraction in the number of users. And I guess when I mention the word meme stock to you now, has that and the contraction with uncertain platforms today, because maybe there's disinterest, maybe they didn't make any money, maybe people lost money, maybe there's just a lack of expertise, whatever has it. When I mention meme stock today, what comes to mind?
What comes to mind is the core of our problem. Really, one of the most important things that's happened in this market over the last week was an interview on a podcast with Joe Weisenthal and Tracy Alloway at Bloomberg, where they interviewed the CEO of FTX, the crypto exchange, that's currently hosting a bunch of famous people in the Bahamas for an event. And they asked him to describe one of the popular ways to make money in crypto right now, which is what's called yield farming. And the long story short, I'm not sure if really intentional or if it just slipped out or what, but the head of arguably the most important and actually is the richest crypto persona in the world, Dan Bankman-Fried, admitted and described the process of making money through this crypto technique of yield farming. It's a Ponzi scheme. He very explicitly said it. Everybody on the podcast was just agape and shocked how clearly he described what is a Ponzi scheme, describing how so many of these worthless products and tokens have now been functioning basically as a pure liquidity trade where they just attract more buyers to keep prices going. And that is essentially most of the crypto ecosystem. And part of his justification for why this Ponzi scheme exists in the crypto world is because the same concept exists in companies like GameStop that in his mind might be worthless, or stocks that have very little obvious fundamental worth, but whose prices and market caps are soaring because enough people have decided that they want to buy it. That is our problem right now in a nutshell. It's purely a liquidity function, and that liquidity is being taken out of the market. We still don't know the ramifications of what we did last year. At the time, it was probably the right call to try and prevent the unnecessary deaths of people by keeping us inside and paying us to stay inside. But it's looking like that calculus is getting somewhat difficult now in retrospect, given how many people did die from COVID anyway. And now our very rampant inflation and these completely asinine valuations in ridiculous companies that have no future, like GameStop, in my opinion, and crypto assets that have absolutely no utility whatsoever. All of these were able to function, and people were able to not sell these assets for a very long time because there was always another buyer there, and that another buyer was created because somewhere there was liquidity entering the market. As the Fed brings this liquidity out, we're going to see most of these assets eventually over time go to zero. That's what happens if you have no fundamental worth. And so when you say meme stocks to me, that is basically the stock and equity market version of the most extreme speculation that will come crashing down. It is not a matter of if, it's a matter of when. And I would alert people to watch Bitcoin as the clearest potential example of when this might happen. Bitcoin has not broken yet, but we have seen that it has no inflationary hedging capacity. It is a higher beta version of the stock market. It's doing worse than the stock market during this inflationary period. And when it breaks its support line, if it does, then that'll be the sign that this community is officially kind of giving up on assets that have very little utility relative or no utility relative to their market cap value. And the stock market will also behave similarly, as Bitcoin and the stock market now and the NASDAQ have been trading in a perfect correlation. It's become very clear that the crypto world is basically just a giant speculative game, and it will all come crashing down. It looks like it's going to come crashing down quite soon.
Well, there you heard it, folks. I rhetorically, this is not a question. This is rhetorical. I often wonder if we're ever going to get back to fundamentals and looking at what you described, which is the fundamental analysis of businesses and how they make money. And I lived through the late 90s into the 2000s. Well, obviously I've lived into the 2000s, but I experienced the ups and downs of some of these speculative bubbles, and a lot of them were not based on fundamentals. So we'll leave it there, Oliver. Always great to hear your insight. I mean, you bookmarked that or bookend, I should say, the programming at TD Ameritrade Network during the day, 5 days a week. You bring a really amazing perspective. Oliver Rennick, always a pleasure chatting with you. Thanks so much for joining us, and we look forward to having you back on the program again very soon, my friend.
Thanks, Jeff. Appreciate it. Sorry for the negativity, but it's the truth.
Hey, that's what we offer here. We want the facts.
I'll see you on the podcast, and if I'm wrong, I'll tell you.
Thanks, buddy. Take care. Have a great rest of the weekend.
That wraps up this episode of BRN Sunday. Have a topic of interest, someone you think we should talk to, drop us a line. And don't forget, for all the latest curated news in lifestyle, wellness, finance, tech, so much more in all in one place, check out today's edition of our daily newsletter, The Morning Pulse. Want to search our content or check out our latest videos? Well, visit our website, that's www.broadcastretirementnetwork.com, and our streaming partners like Amazon, Roku, Samsung, over 100 to choose from. We're back again tomorrow for another edition of BRN AM. Until then, I'm Jeff Snyder. Stay safe, keep on saving, and don't forget, roll with the changes.